Take a look at the Bloomberg here. This shows the tightness that we begin to see. So the white line is the price now of oil versus the price in 2 months. And then the blue line is the price in December versus the price in December of 2008. That's kind of the contract short and longer term that you look at to see the markets actually tightening. The closer you get to the white line, the closer you are to real tightening. Chris, do you feel like this macro picture is being reflected in the oil price?
I think it is. The spread that we like to look at our shop is the Deepwater Mars Sours differential.
Wow, that is some serious oil nerdiness for 753. That beats me.
We try. And basically, it's sour crude out of the Gulf of Mexico that gets pumped into the Gulf Coast refinery system. Back in 2012, 2013, when there was a wide spread between Brent and WTI, refiners were able to buy WTI at a discount, blend it with Arab-heavy imports, and create a sour cocktail that backed out Mars imports. You've seen that spread tighten year to date. So right now it's trading around a negative 50 cents differential. It's up off lows of about $1. I think it's seasonal. I don't think it's showing a longer-term structural tightening in the market. So we'll see going into the fall. We're expecting refinery utilization, as I mentioned earlier, to fall off into September and remain cautious into the fall.
So then that brings us to U.S. producers, because as long as they pump, that means we're not going to see that fundamental tightening in the market. So it seems like after the earnings calls of EOG, of Pioneer, those are really the pure shale plays in the U.S. What did you learn?
So when you look at the transcripts or listen to the conference calls of a lot of the E&Ps in the U.S., there's several messages. So one, I think the broad message remains efficiency is real. Capital efficiency companies are continuing to grow output while lowering CapEx. So that's been a key message for managements that's driven a lot of the cautiousness in the market over the last year. You had a couple hiccups. Pioneer Natural Resources encountered a little bit of gassy pay in some of their key acreage. It's definitely checked a little bit of the growth story. So as I'm sure you guys know, when you get a re-rating of rate of change in an equity growth story, multiples compress. So we've seen a lot of downside pressure on some darling E&P stocks in the Permian. But for the commodity, the broad message remains the same.